Welcome to our exploration of global macro hedge funds, a fascinating world where investment strategies are shaped by economic trends and global events. In this video, we'll uncover how these funds operate, what makes them unique, and why they're so influential in the financial markets. Whether you're an investor, a finance enthusiast, or simply curious about how big money moves in response to world events, this journey will provide valuable insight. Let's begin by understanding what global macro hedge funds are and why they matter in today's interconnected economy. Global macro hedge funds are investment vehicles that seek to profit from broad economic trends across countries and asset classes. Unlike traditional funds that may focus on stocks or bonds from a single market, global macro funds look at the big picture. They analyze economic indicators, political developments, and central bank policies to anticipate market movements. This approach allows them to invest in currencies, commodities, equities, and fixed income instruments around the world, making them highly versatile and adaptive to changing economic conditions. Roots of global macro investing can be traced back to the 1970s and 1980s, when legendary investors like George Soros and Julian Robertson began using macroeconomic analysis to guide their trades. Over time, the strategy evolved, incorporating more sophisticated models and technology. Today, global macro funds are known for their flexibility and ability to capitalize on both rising and falling markets. Their evolution reflects the growing complexity of the global financial system and the need for dynamic investment approaches. Global macro hedge funds employ a variety of strategies to generate returns. These include directional bets on interest rates, currencies, and commodities, as well as relative value trades that exploit price differences between related assets. Some funds use discretionary approaches, relying on the judgment of experienced managers, while others use systematic models driven by data and algorithms. The diversity of strategies is a key strength, allowing funds to adapt to different market environments and economic cycles. The heart of global macro investing is the identification of major economic themes and trends. These might include shifts in monetary policy, geopolitical tensions, or technological innovation. By analyzing these macro drivers, fund managers position their portfolios to benefit from anticipated changes in markets. For example, a fund might invest in emerging market currencies if it expects global growth to accelerate, or short government bonds if it predicts rising inflation. Economic indicators play a crucial role in shaping global macro strategies. Data such as GDP growth, inflation rates, employment figures, and trade balances provide valuable signals about the health of economies. Fund managers closely monitor these indicators to anticipate central bank actions, currency movements, and shifts in asset prices. The ability to interpret and act on economic data is a defining skill for successful macro investors. Currency markets are a major focus for global macro funds. These markets are highly liquid and sensitive to economic and political developments. Macro funds may take positions in major currencies like the US dollar, euro, or yen, or explore opportunities in emerging market currencies. By analyzing interest rate differentials, capital flows, and policy changes, managers seek to profit from currency appreciation or depreciation. Interest rates are a powerful driver of asset prices, and global macro funds often make bets on the direction of rates in different countries. By analyzing central bank policies and economic conditions, managers can position their portfolios to benefit from rising or falling rates. This might involve buying government bonds in countries expected to cut rates, or shorting bonds where rates are likely to rise. Interest rate strategies require deep understanding of monetary policy and market expectations. Commodities like oil, gold, and agricultural products are another important area for global macro funds. These assets are influenced by supply and demand dynamics, geopolitical events, and currency movements. Macro managers may invest in commodities directly or through derivatives, seeking to profit from price trends or hedge against inflation. The ability to analyze global supply chains and market disruptions is essential for success in this area. While not always the primary focus, equities can play a significant role in global macro portfolios. Managers may take long or short positions in stock indices or sectors expected to outperform or underperform due to macroeconomic trends. For example, a fund might invest in technology stocks during periods of innovation or short financials during banking crises. Equity strategies are often used in combination with other asset classes for diversification. Global macro funds can be broadly categorized as systematic or discretionary. Systematic funds use quantitative models and algorithms to identify trading opportunities, relying on data-driven signals. Discretionary funds, on the other hand, depend on the insights and experience of portfolio managers who interpret macro trends and make judgment calls. Both approaches have their strengths, and some funds blend the two for a balanced strategy. Managing risk is a cornerstone of global macro investing. Funds use a variety of tools to control exposure, including stop-loss orders, position sizing, and diversification across asset classes and regions. Scenario analysis and stress testing help managers prepare for unexpected events. Effective risk management not only protects capital, but also enables funds to take calculated risks when opportunities arise. Global macro funds often use leverage to amplify returns and short selling to profit from declining markets. Leverage involves borrowing capital to increase the size of positions, while short selling allows funds to bet against assets expected to fall in value. These techniques can enhance returns but also increase risk, making disciplined risk management essential. One of the defining features of global macro funds is their ability to diversify across regions and asset classes. By investing in different markets, currencies, and instruments, these funds reduce reliance on any single economy or sector. This global perspective helps them weather local downturns and capture opportunities wherever they arise. Several hedge funds have become legendary for their success with global macro strategies. Firms like Bridgewater Associates, Soros Fund Management, and Brevin Howard are known for their bold bets and impressive track records. Their stories highlight the potential rewards and challenges of macro investing, as well as the importance of research, discipline, and adaptability. One of the most famous global macro trades was George Soros's bet against the British pound in 1992. By analyzing economic and political conditions, Soros concluded that the pound was overvalued and would be forced out of the European exchange rate mechanism. His fund's massive short position led to huge profits and cemented the reputation of macro investing as a powerful force in financial markets. Advances in technology have transformed global macro investing. Today's funds use sophisticated data analytics, artificial intelligence, and high-speed trading platforms to analyze markets and execute trades. Technology enables managers to process vast amounts of information quickly and identify patterns that might be missed by traditional analysis. This digital edge is increasingly important in a fast-moving world. Global macro funds operate within a complex regulatory environment. Different countries have varying rules on leverage, short selling, and derivatives trading. Compliance with these regulations is essential to avoid legal issues and maintain investor confidence. Managers must stay informed about changing laws and adapt their strategies accordingly. Performance of global macro funds depends on several factors, including the accuracy of macroeconomic forecasts, the timing of trades, and the effectiveness of risk management. Successful funds combine deep research with disciplined execution, constantly monitoring markets for new opportunities and threats. Performance can vary widely from year to year, reflecting the unpredictable nature of global events. Market volatility creates both risks and opportunities for global macro funds. Sudden changes in economic data, political events, or central bank decisions can lead to sharp price movements. Skilled managers use volatility to their advantage, adjusting positions quickly to capture gains or limit losses. However, high volatility also increases the potential for large drawdowns, underscoring the importance of robust risk control. Liquidity is a key consideration for global macro funds. The ability to enter and exit positions quickly is vital, especially during periods of market stress. Funds typically focus on highly liquid assets like major currencies, government bonds, and large-cap equities. Maintaining liquidity helps managers respond to changing conditions and avoid being trapped in illiquid markets. Global macro hedge funds typically attract sophisticated investors, such as institutions, endowments, and high-net-worth individuals. These investors seek diversification, absolute returns, and exposure to global trends. The complexity and risk of macro strategies mean they may not be suitable for everyone, but for those with the resources and risk tolerance, they offer unique opportunities. Global macro funds typically charge management and performance fees. The classic 2 and 20 model means a 2% management fee on assets and a 20% performance fee on profits. While fees have come under pressure in recent years, top-performing funds can still command premium pricing. Investors should carefully consider fees in relation to expected returns and risk. Transparency is an important issue for global macro funds. Investors expect regular reporting on performance, risk exposures, and portfolio holdings. While hedge funds are less regulated than mutual funds, industry standards for disclosure are rising. Clear communication builds trust and helps investors make informed decisions. Global macro investing is not without challenges. Predicting macroeconomic trends is inherently difficult, and even the best managers can be wrong. Political shocks, policy changes, and market disruptions can lead to losses. The complexity of global markets requires constant vigilance, adaptability, and a willingness to learn from mistakes. Crises often create unique opportunities for global macro funds. Market dislocations, currency devaluations, and policy shifts can lead to outsized returns for those able to anticipate and act quickly. The ability to remain calm and analytical during turbulent times is a hallmark of successful macro investors. Global macro hedge funds can have a significant impact on financial markets. Their large trades can move prices, influence liquidity, and even affect policy decisions. While some critics argue that macro funds contribute to volatility, others see them as providing valuable liquidity and price discovery. Their influence reflects the scale and sophistication of their strategies. The future of global macro hedge funds will be shaped by technology, regulation, and evolving market dynamics. As data becomes more accessible and markets more interconnected, the ability to process information quickly and adapt strategies will be crucial. Funds that embrace innovation and maintain disciplined risk management are likely to thrive in the years ahead. Sum up, global macro hedge funds offer a dynamic approach to investing, leveraging economic trends and global events to generate returns. Their strategies are diverse, their risks are real, and their impact on markets is undeniable. For investors seeking diversification and exposure to macroeconomic forces, these funds provide a compelling option, provided they understand the complexities involved. Thank you for joining us on this journey through the world of global macro hedge funds. We've explored their strategies, risks, and the economic trends that drive their decisions. As the global economy continues to evolve, these funds will remain at the forefront of innovation and market adaptation. Stay curious, keep learning, and remember that understanding macro trends is key to navigating the ever-changing landscape of finance.